Miss Any. Hi, good afternoon, everyone. Thank you for joining the Arch Indices webinar today on optimizing income portfolios. I am Yang Tang. I am the CEO and co-founder of Arch Indices. And joining me today is Michael Cronan, the esteemed president of ETF Insight and an ETF marketing guru.
I always hate that term.
Okay. An esteemed ETF marketing
guy.
All right. So, all right. Why don't we have a presentation here as well? And there is a chat if you would like to ask questions. So this is recorded. We will put this up on YouTube as well. We started this a couple minutes early just to make sure everything worked. But yeah, this is the start. Today's topic is optimizing income portfolios, which is a very relevant topic given one, the need of income, the opportunities with where yields are right now, as well as really the market volatility. So Mike, why don't I turn it over to you?
Great. Thanks everyone for joining us. As Yang said, we're here to talk about income portfolios and specifically the Arch Indices income portfolios. So Yang, I'll turn it back over to you, but can you just answer, what is Arch Indices and what are you guys really focused on right now?
Yeah, so I'll start with the first slide here, our core mission and values. Really, we were founded with the mission of building an optimal portfolio for investors. And we define an optimal portfolio as one that maximizes an investor goal while minimizing volatility. So our core mission is to empower everyone to achieve their goals through our next generation passive index products. So really what we have is we built a proprietary weighting methodology, which we call Variance Optimized Indexing, or VOI. And that's the core of our portfolio construction backbone. We started the company last August, and we're a relatively new company, but my co-founder, Dr. Jacob Kwong, and I have been in the industry of fixed income and derivatives and macroeconomics for a combined 40 years. Dr. K is a PhD in math. He started at Solomon Brothers in the mid-90s, and we actually worked together at Citi about a decade ago, and we just remained friends since. Most recently, I ran the solution sales desk at a major bank, and we really started this company last August as a intellectual property company. So we're mission-driven. We're an intellectual property company, and we're really looking to partner with financial advisors to help them meet client goals. As I mentioned, we have a proprietary methodology we developed called VOI, which we use to construct portfolios. And we distribute our IP through model portfolios. Our investment advisor went live over the summer, and we can offer custom SMAs. And we had an ETF launch, our income ETF launch beginning of this month.
Great. Yeah. And so, VOI is the core of your methodology. Why don't you tell us a little bit how it works and how your portfolios are constructed?
Yeah, I'd love to. So this slide may be a little bit premature, but what sets apart us at Arch is that we optimize for a goal, which most portfolios out there are built for market exposure. Ultimately, as investors, very few investors have a pure market exposure goal, right? Most people have a retirement goal, a capital preservation goal, saving for a home, so forth. On the institutional side, there's asset liability management. For example, life insurers deliver a goal of, really a retirement product or a savings product packaged. So when you think about the world, there's active management, which honestly does not work super well as a group, right? The human mind has many errors in human judgment, and active management is, as a whole, relatively an underperformer. And the current passive products are really arbitrary and static. They use a simple arbitrary approach, such as market cap, equal weight, inverse rank. And while that may work in certain applications, the applications really are limited. As an example, everyone knows that market cap indices work pretty well in stocks, but on the fixed income side, market cap bond indices actually don't work. Because number one, the difficulty of replicating, and number two, the biggest issuers in the market are not representative of the bond market. So those are flaws there, and we really try to correct for that in our approach. And when you think about expanding next generation passive solutions that we're building here, there's a common misconception that passive is really just about low-cost market cap products. It's really about systematically allocating assets to reduce errors from human judgment. So I guess that's a long-winded way of saying our focus. Our focus is really to optimize for an investor goal, to be rules-based and transparent in how we do it, and to dynamically rebalance to changing market conditions. And as Mike, I know you're a former journalist. You know that indices have been around for some time. It's originally a newspaper product, started by Mr. Clarence Dow. And when you think about that, the first innovation in indices happened in 1987 when the S&P went from price weight to market cap weight. And of course, there's been a huge movement in passive indexing driven by Vanguard and the idea of the BOGO low cost portfolio, which is great. And those have served investors tremendously well. So people vote with their dollars. You see a proliferation now of really custom indices, life cycle products. And which is trying to meet the investor goal, right? But the portfolio construction process is arbitrary. So that's what we're trying to correct for. The next generation of indices for us is about aggregating inputs, going from aggregating inputs to optimizing an output. So what does that mean? Instead of replicating market exposure, we want to meet an investor goal. Instead of having an arbitrary way of picking companies, we want to have an asset selection that is transparent and it's designed to reduce volatility through our VOI engine. And instead of a market cap or equal weight, we want the output to be optimized for both volatility and correlation.
Okay.
Now back to your original question, VOI. So what VOI is a portfolio weighting methodology. And think of it as constructing a house. That's how we construct portfolios. And we use this to determine the optimal basket. So we take account really three things. The first is the asset output or the goal. The second is the asset volatility, and the third is the correlation to the entire portfolio. And VOI weights assets to maximize the goal that we target and minimize the overall expected portfolio volatility. And this is quite customizable as long as you're able to have some certainty around the goal and the constraints. The world's your oyster on this.
Yeah, and so how does this compare to other optimizations that are out there?
Sure. So as an example, we can talk about one of the proprietary things. We, of course, have, a lot of the optimizations, I think, were built around the efficient frontier. And the idea of the efficient frontier in the modern portfolio theory predates both of our time on this planet. Harry Markowitz wrote this paper in the 50s. So the first thing that, is a problem is most optimization tools in the market use a covariance matrix to optimize, and they don't set a specific goal. So you may have heard the matrix optimizer. It refers to putting asset covariance into a matrix and using that as the optimization backbone. It's actually the vast majority of optimizers out there, and many of its flaws were highlighted in a paper called Honey, I Shrunk the Covariance Matrix, published 2 decades ago. The matrix optimizer is actually a pretty limiting tool in terms of the number of assets it can handle and stability issues. So within VOI, we built a second process, which is a recursive process. We call this the building block methodology. And you can see here that what we do is we start with 2 of the least correlated assets, and we add in asset by asset until adding another asset does not either increase the output, and using our income example, yield, right, or does not decrease volatility. So that's when the portfolio reaches an optimal state, and we again run this, a few times, actually more than a few times, to make sure the results work. So it's a very different construction process than a matrix optimizer, and it's really built on a derivative lattice framework. Right? So the second thing is, the biggest flaw of optimization is the handling of the goal. The idea of the efficient frontier was built around expected returns.
Right.
Honestly, it's impossible to forecast the returns of any assets with any degree of certainty, right? This year is a great example. How many people forecasted NVIDIA, Tesla, and 30-year bonds today at the beginning of the year? I would think it's almost zero. So as practitioners, what you really have to aim for is to find the right observable metric to meet the goal of the portfolio and optimize for that. And there's many ways to think about this, but it really comes down to building a solid framework. There's a lot of low volatility, minimal volatility products out there. It's still logical to really use a screener of stocks and just pick the ones with the lowest observed volatility. Because the first issue is what happens if they're all concentrated? So, if you go look at 2009, a lot of the low volatility names were healthcare stocks. And guess what? Obamacare showed up in 2010, and some of those stocks were not so low volatility.
Right.
The second thing is, a lot of them, some minimal volatility indices out there do use correlation. And what the idea is, you use the portfolio basket, you have a large number of stocks, and you go, what is the optimal portfolio of these stocks to minimize volatility? But in this case, there's no goal. You have optimized not for a goal, but rather just to have low volatility, which is fine. But at the end of the day, that has some flaws in how you think about one versus the other on those 600 stocks.
And so, how should investors think about, a goal of income and multi-asset portfolios?
Sure. So why don't we use a case study here, our Arch Indices Core Absolute Income Index, VOIWWI. And in this context, when you think about this is a multi-asset index. So investors should be indifferent between a stock and a bond in terms of generating $1 of income. Of course, there's a tax difference between dividends and bond coupons. So I guess maybe we'll keep this more to a portfolio construction perspective because, at the end of the day, everyone's taxes are different anyways. For example, you and I live in a high tax state such as New York. Some people live in states without capital gains taxes. Some people live in states without a state income tax. So it's hard from, that perspective, but, we'll keep it, more of a portfolio construction here. So a multi-asset income portfolio is really built around the question of where can you find the most amount of income and the least amount of volatility? And think about correlation. Correlation occurs between stocks within a sector. Correlation occurs amongst different sectors of the stock market as well as the bond market. And correlation occurs between stocks and bonds, alternatives and gold and so forth, right? So there's really three levels of correlation you're thinking about here, which gives you a lot of tools and a lot of data, to construct an income portfolio. So, if you kind of look at our absolute income index, we really try to use those three levels of correlation and picking out the optimal income portfolio. Right.
Great. And then can you tell us a little bit more about VOIVWI and the Arch Indices Absolute Income Index, and how does it compare to other products?
Yeah, so that's a great question. So our product is really built around having dividend stocks and bond ETFs to generate income. So how do we pick those dividend stocks? Well, it's a Springer process. So we start with minimum 2 billion market cap, minimum 3-month daily average trading volume of 20 million, minimum 3% dividend yield, which is where the absolute term comes from, and a 5-year regular dividend history. And just note that this is the criteria for inclusion. We don't actually remove securities unless there's a corporate action. So in this process, you end up with about 450 available securities at the moment, and we pick 12 bond ETFs to represent the biggest parts of the U.S. bond market. And using a bond ETF is so much more efficient than using a one-by-one individual bonds, especially for scalability and transparency and liquidity. So at any given time, this thing will hold about 60 to 100 stocks and 6 to 9 bond ETFs. And it dynamically rebalances every quarter with changing market conditions, which is something that you don't see in static products. So at the moment, there's about 84, 85 individual stocks and 8 bond ETFs. And the next rebalance is November. And of that, it's about 81% stocks and 19% bond ETFs. And within the bond ETF space, actually, the majority weighting is AAA CLOs and TIPS, which reflect the low correlated nature of AAA CLOs and the positive real yield you see in the TIPS market right now, which is inflation protected security. So relative to other products, we put the slide here together for a visual here. So this is our total return from May of 2018 to today. The index really went live May of this year. We have a third-party calculation agent as of last month to calculate this alongside with us, with the index administrator.
Right.
You can kind of see this is really reflective, I guess, of the S&P 493 over the last 5 years, which is just the state of the market at the moment. So these are some common income products out there, and we picked 3 just for comparisons. And the blue line is the high dividend index, which is a very well-known, well-tracked one by investors.
And these are total returns.
Yeah, this is in total return.
Yep.
So the red line is the preferreds, which surprisingly have gotten a lot of attention. I don't like preferreds, and we can talk about why in a little bit. And the third is the gray line is IG corporates. So how does this compare on yield? The current portfolio yield of our income index is 6.5%. Preferreds yield around 7%, and high dividend stocks yield around 4%. Just as a comparison, IG corporates are 6.4, and U.S. Treasuries are a little north of 5, depending where you are. So you can see that the returns are very interesting, right? We have similar total returns to a high dividend index, but we have much less realized volatility, and we have a much better performance against preferreds and IG corporates, but the IG corporates do exhibit a bit of a lower volatility given just the nature of that product. We'll look at this, and the yield is just only one side of the coin. I mentioned earlier that I don't like preferreds. I don't like preferreds because they're wrongly risked.
What do you mean by that?
Yeah, so they're wrongly risked in that they have a lot of downside of common stocks, but they have none of the upside. And people think of them as a very safe product, when in reality, 80% of the market is financial issuers and 50% are banks. And then you can actually see this in the graph. The red line is the realized volatility this is the realized 21-day realized volatility. Yep. So you can see the red line is the preferreds and the blue line is dividend stocks. Of course, you expect dividend stocks to spike when there's market volatility, especially say COVID of March 2020, as well as this year. But what's really surprising is that preferreds actually have higher volatility during times of stress, right? Because, in a crisis, the financials, there's a lot of bad things that can happen to a financial, sector. Like, as an example, March of this year, right? What do you think a $25 preferred from Silicon Valley Bank, Signature Bank, and First Republic Bank trade at today?
Right.
I can tell you the answer is pretty close to zero.
Yeah.
So of course, by that metric, right, the preferred market has a lot of downside but very limited upside. And of course, you expect dividend stocks to have some higher volatility because, in general, there's been higher realized equity market volatility. Just doesn't feel that way in bond market right now. That bonds are more volatile than stocks today. It just doesn't feel that way. But historically, bonds have been a lower volatility asset class. So yes, I think this is interesting. We think about this more of risk, and the dark purple line is is our house color. That's our income index. And it really is interesting from that perspective. So
now, when you say the bond market has been volatile, I mean, how are you thinking about higher for longer?
Oh, it's crazy. It's this is such a long topic, but in reality, I think a lot of people have found out this year that inflation is very stubborn, and in many ways, we've moved from an era of low structural deflation to structural inflation. Think about demographics, right? Think about how many people are retiring. We have a whole webinar on income because there's 13,000 people retiring every day.
Right.
It's just harder to come by workers, right? And obviously, there's a very, and the government policymaker change towards offshoring and reshoring of change, as well as free trade, right? When you think about the Walmart effect of the 90s, the supply side effect, right? Think how much Walmart took off of inflation in the 90s. Amazon's the biggest retailer today, and Amazon's actually inflationary because the cost of delivering logistics and increased volume actually increases. Whereas Walmart was very deflationary in being able to push down costs. Think about just where China was in 1989. When my family left communist China, the per capita income in the late 80s was $300. Today, you're approaching $12,000. So the labor savings, even if there's support to offshore, which there's been structural changes on that in terms of our country and reshoring, right? Just emerging market incomes have gone up a lot, tremendously a lot. So that's another problem. And then, now the goal of the policymaker of our country is to reshore. And while that's a great goal, from a country perspective, it is actually inflationary. Think of how much capex you need to put in here. You got to build factories, you got to do logistics, you got to find people. It's, you can't just go find a steel worker, right? I mean, for somebody to weld is actually a really hard skill. And it takes time. So it's just, all of these things are inflationary, and you see that. So the higher for longer, in this scenario is the Fed has less ammunition to lower, to ease financial conditions when market turbulence hits. And we see that, right? Like yields hit 5%. What does Jerome Powell do yesterday? He talks about, kind of the pause and all this, but in reality, like what can he do until inflation gets, down to 2%? The market's just going to stay volatile. We see that in the bond market today, right? The 30-year bond trades almost like an emerging market stock these days. And that's crazy, you know. And it's wild, and people just, and this is not going to go away.
I see like the CNBC anchors are like thrown by how much volatility is when they're talking about the bond market. They seem to really be caught off guard by how much it's changing.
Oh yeah, 100%. And there's so many structural things that have happened to the bond market, right? Like dealer inventories have gone down. The buyer base have changed, especially in overseas buyers, right? The U.S. dollar is so strong. Look at Japan's one of the biggest investors in the U.S. Treasury market. Just look at where the dollar yen is today. It's crazy, right? Yeah. So we can talk about this, of course, all day, and this will be a great webinar topic. And we have a whole paper. We actually wrote a whole email about structural inflation versus structural deflation. If you're curious to learn more, please do reach out. We could talk about this all day long. But maybe we'll just shift it back to one topic, just to talk about a little bit more of the what you talked about, the higher for longer. Just even thinking about dividend stocks here, right? We graphed against the high dividend index. You can see that over a 5-year period, our total returns are similar, but we run about 71% of the 1 month realized volatility. And especially look at March 2020, right? This, of course, is a hypothetical back test, but the drawdown was actually 10% lower in a product like this, and it bounced back faster because the Fed was able to ease the COVID right away.
Right.
Of course, where does this go wrong? Well, this goes wrong when the Fed, goes kind of nuts in a year like 22. 22 was just a poor year for correlation, and everyone talks about correlation being up. We're not so much concerned about that. We're more concerned about rapid changes in correlation that you saw in 22. Right. 22 was a rapid change in correlation. This year has been a change in correlation, but in a more stable environment, you do a little. It's much more palatable for a product like this.
Yeah.
And I can show this as well. With some quick facts here as well. Just how diversified this is. There's some large. The top 10 holdings are quite large. It's very exposed to consumer staples. It's of course that's kind of what you expect in this environment. These are very stable names: British American Tobacco, Philip Morris, IBM. Very well-known names: JAAA, VTIP. Those products do deliver what we expected to deliver. And if you think about where this index was maybe 6 months ago or a year ago, you have more energy. And you think about the volatility in the energy sector, that really increased this year, right? Energy was a wild ride this year, so VOI naturally decrease exposure there. I think to your point about the higher for longer, the 30-year bond is over 5%, which is I think the highest it's been in almost 2 decades. Right. The 30-year mortgage rate is the highest since I think I was
8%,
8.5%. Yeah,
wow.
I was in middle school the last time rates were here. I'm not a young guy either. I'm not old, but I'm not young either. By that metric, like. It's a really different world, and it's not that the 5% is appealing to VOI if the volatility spikes, right? The performance ratio, you're thinking about yield versus volatility. If the yield goes up and so does the volatility, that's our methodology just kind of goes, that's interesting, but at the end of the day, you're looking to maximize the performance ratio, the yield versus volatility, and you're looking for low to negatively correlated assets that have high performance ratios. So you're getting a high performance ratio, but the performance ratios don't move together. So that's how you're able to reduce the volatility and get to a high yield without so much of the downside risk, right? And this is 81% dividend stocks. So for that level, you also get some of the exposure of potential capital appreciation of these companies.
Right. Well, that's great. It's a great walkthrough. It's a great summary. Are there any other things that you want to highlight for our guests on the webinar today?
I think we captured it very well. I think maybe we give it 30 seconds. If anyone wants to type a question to the chat, we're happy to answer now. If not, you know how to reach out to us. Well, our website is archindices.com. You can, of course, reach out to us there. You can find us on LinkedIn. We have a lot of good content on LinkedIn.
That's right. You have a great weekly email that you send out and post on LinkedIn.
Correct.
For the folks that are interested.
Yeah, and if we talk a lot about macro, we talk a lot about markets, we talk about correlation. If you want to nerd out with us a little bit and think about this, we're more than happy to have you along. You can sign up on on LinkedIn on our website. If not, just add me on LinkedIn. We'll love to connect with you. We're a new company, but we have 40 years of combined experience. We have the right talent. The world has changed so much in financial products.
Yeah.
We wanted to start this company just to take advantage of some of the structural shifts that have occurred in the secular shifts, and especially the index and the ETF space.
And the timing's great, right?
Yep.
We came out of the summer of income, and now we're in the fall of income,
Yep.
and you have a very strong, income product that's available in the form of the index, and I think people would find it at your website as well, right?
Yep.
The URL for that is
Arch, ARCH, Indices, INDICES.com.
great.
Yep. So thank you so much for joining us. It was a pleasure to have you. And, please do feel free to reach out. We're very accessible.
Thank you.
Thank you. Take care. It was a pleasure to have you. And, please do feel free to reach out. We're very